committee raised the target range for the federal funds rate by 75 basis points. We still think there's a need for ongoing rate increases. But we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
We don't need to see inflation come down significantly before we slow the pace of rate hikes.
We've deteriorated and we're at the lows, near the lows of the session here. The S&P is going to go out down 2.5%, which brings the week down to 3.6% heading into a Thursday and then a jobs Friday.
You're with us here on Bazaar Morning Call. I am Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Good morning.
Good morning.
I mean, it's lower, definitely lower, and there is no pivot. I mean, the question is, can the markets pivot without the Fed pivoting? And I think the answer is very clearly no. I think we put out the SGX Nifty rate, which is indicative of what the market is likely to do. Asia is lower. US markets ended lower. Boy, what a volatile session. Actually, the initial reaction was higher in US. And then all of it reversed as the press conference started. The market in the US ending lower. The Fed is hawkish. Overall, the message is hawkish, and we'll detail that out in a little more in a bit from now. The dollar saw a massive move. I mean, it sold off to 110 and then reversed all the way to above 112. So, I mean, not the kind of price action you want to see. And you got the SGX, which is down, under 18,000, about 17,989. Where do we go from here? That is the big question as we start today's session. Guys, hi.
Hi, morning, Nigel. Absolutely. I mean, for now, the SGX Nifty is indicating that the start will be in the red, and for the reasons that you mentioned, right? I mean, the Dow is down over 500 points, and the chances of a soft landing have narrowed after yesterday's meeting for sure. The Fed reiterating that they are not done with rate hikes just yet. Jerome Powell saying that it's premature to talk about any kind of pause in rate hikes, and the terminal rate would likely be higher than what was previously stated. So they're not done with the inflation fight just yet, and this is something that has perhaps spooked the markets. The next important report, as you just heard a while back also, is the October non-farm payrolls data that comes out tomorrow. So we'll track that very closely. But my own view is for the Nifty, yes, the Nifty could stall today around that 18,000, 18,100 mark. But things have looked good in our own market. So perhaps it's just a matter of time. Once the global markets stabilize, maybe the Nifty could take out those highs. In that context, the earnings season has progressed very well. One of the reports that came through this morning is from Motilal Oswal, where they've gone ahead and raised their Nifty FY23 EPS targets by 0.5%. And the upgrade is driven by strong earnings from the likes of Axis Bank, Sun Pharma, ICICI Bank. So just keep that in mind. Despite all the global volatility, our own markets have strong fundamentals backed by good amount of earnings. In that context, the FII money continues to come in thick and fast. FIIs have bought, there was a big buy figure yesterday as well. And in total, in the last 5 days, 12,600 crores has come in. So perhaps, I mean, of course, today, there's a gap down opening. The market could trade lower because of the global fears. But give and take everything, this has been a buy on dips market, so I won't be surprised if that trend resumes again.
Sonia, for today, I'm not so sure whether that really plays out or not. And this is what we were talking about yesterday as well, that we've seen this movie before, that the market, and I think we had a guest on yesterday at the same time in the morning who made that point that the market got very excited, worked up that a pivot is coming, a pause is coming, and then nothing came. Then there was that Jackson Hole speech, and then there was the Fed meeting itself, the CPI numbers. And everything came off. So I think what this does is this kind of puts a cap to the trading rally that we've seen in the US. I mean, we've been doing our own thing, but the big question is, can this divergence continue? I think we come back to that old question. Overall, I mean, what's happened last night puts a cap to any kind of big move from here on the upside. What it does on the downside, we'll get to it just a bit. But before I get to that, let me just quickly outline what happened as part of the Fed meeting. So the Fed chair indicated, Jerome Powell indicated that the pace of hikes may come off starting December. So it's possible that there may be a 50 basis points hike in December after 4 75 basis point hikes. I mean, it's incredible. And what he said is that we need to take into account the effects of the cumulative tightening so far. The cumulative tightening has been about 500 basis points in 10 months flat. So he said we'll need to kind of give some time. And that's why markets interpreted that to say that maybe we'll not see 75, but maybe 50 in December. But he also strongly pushed back against reading into what he said as pausing. He's kind of repeated that several times, that this is not the time to pause. And the other more important thing was that he said that, ultimately where we stop hiking rates to, where the rates will get to, which is the terminal rate, that may need to go a lot higher than what we previously expected. At one point, he said that it's quite surprising that despite all of the hikes that we are doing, tightening financial conditions, inflation, labor markets, everything remains so strong. There is little slack in the economy. And he also explicitly stated that he would prefer to over-tighten than kind of leave things undone. He said if the economy starts to fall, we've got the tools to support it. But in the first place, we want to be we want to be sure that we've done enough and not kind of prematurely pause. So I think it leaves little doubt, if you heard the commentary, and we'll play sound bites, where this is headed. The market gets excited, and it's very normal for, in a bear market to get rallies. And I think the 10-13% move that we had in the US markets perhaps was just that, a bear market rally. For now, what the message is that maybe a slower pace of hikes, but ultimately the rates are going to be much higher. The setup is basically the fact that risk-reward becomes unfavorable in the near term. I mean, if you're an investor, and you got a different time frame, and I always repeat that difference. You cannot take one rule for both traders and investors. But if you're a trader, I think you got to live day by day, week by week. So all of this matters a great deal. So risk-reward, if you're a trader, becomes unfavorable in the near term. We were talking about whether the Nifty perhaps can kind of get out of this jinx. The market's gotten to this 18,100 level 3 times in the past, only to turn down. And I think that we're going to be unlucky this time around as well, which is a substantial push higher than these levels. So that's what I was talking about. Eventually, and we can talk about 20 hourly moving averages and 40-hour. I think all of that gets taken out today. Ultimately, eventually, I think weekly moving averages perhaps may come into play. The 20-day is far away because the pace of the move up has been so sharp. It's at about 17,500 or so. But I think you need to keep sort of a possibility in your mind that eventually we kind of get to those kind of levels. Not today, of course. The dollar index saw a massive move, as I said. You want the dollar lower. That's the most important channel through which all of this affects emerging markets. The dollar fell to 110 and then rose to 112. Keep an eye out on the currency as well, which I think becomes important. There is the RBI meeting today, and what they say about inflation and the explanation they give to the government in terms of what else they will do to meet their mandate of keeping inflation under control, I think will be very, very important over the next many quarters as well. Nigel, what are you watching?
Well, the market was looking for a Fed pivot. We didn't get a Fed pivot. We got Powell at play, right, yesterday, because initially the markets reacted positively, and then, in fact, they did sell off yesterday.
I'm glad that this word pivot is finally out of the way. I mean, the amount of times we've heard the word pivot, he's put an end to it, right?
For the time being. For the time being, he's put that on the back burner. And yesterday, the point that we made, booking some profits ahead of this big event wouldn't hurt anybody. The reason I had said that was likely to be a prudent strategy is because there are signs of some resistance at around that 18,200, 18,300 odd mark. Whether or not the Fed pivot came or not, that would be a bit of a hurdle. And also the other factor is that we already saw such a big run. We had a 1,000-point move on the Nifty, and the global markets as well had seen a good run. Now, the FI flows, they're going to be tested today. As Sonia mentioned, well, they're pumped in $1.5 billion in 5 sessions. They're going at a run rate of close to 2,500 crores odd, per day for the last 5 sessions. But yesterday, it was only 1,500 crores, which is the lowest we've seen in the previous 4 trading sessions. So the FI flows will be crucial. The dollar index is back around 112, so some signs of stability on the rupee. After opening up weakish, that's something that we'll be tracking very closely as well. And the Nifty IT index, if you look at it from the last week of September, it's actually been an outperformer. The Nifty is up 4-5%, Nifty Bank is up 4-5%, but the IT index has been an outperformer. It's up close to around 8 to around 9% odd. Given that the Nasdaq came in for selling, you have the yields as well that are higher. We'll have to keep an eye out on that one. That could come in for some profit taking today. The FIs in the FNO market, well, it seems they were bracing for a bit of a disappointment. They bought less in the cash market, as I said. They unwound some longs, and they bought some puts as well in trade yesterday. And the bulls, they'll be really missing these FI shorts in the system. Because otherwise, if you start gap down, you're hoping that the shorts cover out. Now, in fact, they're net long on the index. They have closed on 65% of their positions on the long side. The 18,000 put, well, yesterday there was some signs of unwinding out there. The total open interest out there was around 74 lakh shares. So keep an eye out on that. Given that we're going to start lower, if there is unwindings being seen out there, that's telling you the bulls are throwing in the towel. First support comes in at around 17,900. 50 DMA becomes a crucial support zone. SGX Nifty suggesting we're going to be starting closer to around the 17,900 odd. So my guess is today don't be very, very brave. We've already seen a big run. Anticipation of that Powell will do something good for the markets. That didn't really come about. So now.
Absolutely. And, you know, for now, at least the SGX Nifty is indicating a big gap down opening, and then we'll take it from there. Couple of things to watch out for. We once again get back to tracking all the earnings in our markets, and the next couple of days is going to be heavy in that sense. Today, you have Nifty companies, Hero MotoCorp. There's Hero MotoCorp, of course, comes post-market hours. There's HDFC that will come out with earnings. Tomorrow is a big day. There's Titan, Britannia, Cipla, TVS Motor. So a lot of index and non-index companies. And then we wrap it up with SBI on Saturday. So in the context of very good banking earnings this time, SBI assumes importance as well. So we'll track all of that for you. But this morning, things are looking a bit sticky because of the fact that, yes, the Fed was hawkish. They said that this is not a time to pause and they'll continue to fight inflation with higher rates. But let's tell you what some market experts are opining this morning. You have a comment coming in from Eric Fishwick of CLSA, who says that Powell's Q&A session indicated that although the Fed was feeling more confident about being forward-looking, it was still increasing its inflation and therefore rates projection from the September FOMC. He says the confirmation of this will await a revised set of forecasts presented at the December FOMC meeting. Their central case therefore shifts to include tightening past February, and they expect a 50 basis points rate increase in December. Thereafter, a move to 25 basis points increments remain CLSA's central case, with an increase to 4.5 to 4.75% in February. However, they also add that additional rate hikes at the March and the May meeting to their forecast takes the rates to 5 to 5.25%. He says that Fed funds futures are still pricing in rates being reduced in the second half, which is something that they think is unlikely.
Well, Gautam Dugar of Motilal Oswal says that second quarter FY23 corporate earnings so far have been in line with performance of heavyweights such as Reliance, HDFC Bank, TCS, ICICI Bank and Infosys, driving in-line aggregate. He says the spread of earnings has been decent, with 70% of the universe either meeting or exceeding profit expectations. However, he adds the growth is being led by just BFSI and autos, with IT still reporting single-digit earnings growth, while metals, oil and gas and cement are recording year-on-year earnings decline. He says Nifty is now up 4% in 2022 so far. With this rally, Nifty now trades at 22 times FY23 earnings, comfortably above the long period average, and offers limited upside in the near term. In his view, he maintains an overweight stance on financials, auto, consumers and IT, underweight stance on energy, pharma and utilities.
Okay, let's also get you some money market views this morning. First, a comment on the rupee, right? The rupee actually was around its record lows yesterday. Once again, 82.78 is where it closed. Parul Mittal of Standard Chartered says the rupee traded range-bound this week ahead of the FOMC. She expects the rupee to trade in a range of 82.50 to 83.50 as the dollar strengthens post the hawkish FOMC, even as dollar sales by PSU banks may continue to limit losses. Parul adds that a weak risk sentiment, higher oil prices, elevated trade deficit along with real effective exchange rate or REIR overvaluation may continue to keep Forex under pressure in the coming months.
On bonds, Parul Mittal Sinha of Standard Chartered says domestic yields eased on comfort from comments that rate action is unlikely at the unscheduled MPC meeting announced for today. However, she adds low market liquidity and global rate volatility weighed. She says FOMC decision was hawkish with a 75 basis point rate hike and mention of higher peak rate but slower pace of hikes. She expects the 10-year yield to trade in the 7.35 to 7.5% range, largely following global rates.
Well, we have a lot of stock-specific action to track today, and we'll get to that in just a bit in our top 10 segment. We're looking at Dalmia Bharat, Bharat Forge, Ramkrishna Forgings, JK Paper, Gati, MTAR Tech, and Triveni Turbine. They are stocks on the back of positive news flow. While we have Mahindra Financial, Jindal Stainless, and Relaxo Footworks. They are stocks that are likely to open up in the red.
All right, let us listen into what Fed Chair Powell had to say on the rate hike and, of course, the motivations behind another 75 basis point hike. Listen in.
I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will. We'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. We're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. It used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? If we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think.
Ed Yardeni is president at Yardeni Research, and Dean Kim is head of global research product at William O'Neill. Gentlemen, great to have both of you here. Thank you very much. Ed, so this is pretty clear, right, where they want to go with this. So into 2023, he's strongly pushing back on the idea which markets have that we will see rate cuts. So maybe slower pace of hikes, but where we get to will be higher, and then we'll stay there for longer. What's your sense about the market reaction from here on?
Well, I think first and foremost, we should point out that this was all about Powell's interpretation of events and of policy. Clearly, he's the chair, so he's very influential. But let's not forget, there was about a week ago, there was an article in the Wall Street Journal that reviewed that several Fed officials on the FOMC were inclined to start to think about slowing the pace of increases and maybe even pausing. And so we're about to get a whole deluge of Fed officials following up on what Powell said. And I won't be surprised if quite a few of them try to push back on the uber hawkishness that Powell expressed. I think he's had a real tough problems communicating the Fed's intentions because there's too many of them speaking too often. But I still believe that they are going to do 75 basis points in December. That was my belief before. It's my belief now. And I believe that they're going to have to pause early next year simply because we're talking about a major, major increase in the federal funds rate in just 10 months. And I think they need to pause for a while just to see what impact this is having on the economy. And I am reminded of some Fed officials just recently saying that they have to start thinking about stepping down from the pace of increases. And Jim Bullard, who's very often leads the way, he's the president of the Federal Reserve Bank of St. Louis, he very often has anticipated what his colleagues are going to do. And he was promoting the idea of two big hikes in November and December and then pausing.
Okay. Dean Kim is also with us to give us his view. Dean, good morning. This rate tightening cycle has been on for the last 18 months, right? And through that period, markets like India have not only been resilient, but have also almost hit new highs. How high is the probability that despite the Fed continuing to raise rates, Indian markets will continue to trend higher? I mean, as of now, we've not seen any correlation with rising rates and falling equity markets. So what do you think would be the way forward?
Well, Indian market certainly has been very resilient. And I think last time I was on the show, we were talking about how the market should find support or try to look for support at the 200-day moving average on the sensex, and it did that. And I continue to be impressed by the underlying fundamentals for the country. I think a couple of things we need to look out for. One is continued dollar strength, and as well as where Indian rupee is going, as well as the oil price. But from our perspective at William O'Neill, we certainly look at technicals very much. And one thing I would say is there's a lot of stocks breaking out in India at the current moment. A lot of spaces looking really good, but at the same time, there are some extended stocks. So I would say for those stocks that are, let's say 40% above the 200-day moving average, perhaps it's time now to start to take a little bit of profit and trim some position. Because we're seeing reactions in other emerging markets, Asian markets opening up lower. So that may be a trend for a little while. Certainly, the Indian market looks a bit toppish, but certainly, I don't see any kind of signs that Indian market should take a major hit. There's no fundamental data point to support that. So I would say, take some profit on overly extended stocks, and then perhaps switch into stocks that are breaking out from stage one base. There's a lot of opportunities.
All right. Hi, Dean. Morning. I recall that call you made. 200 DMA, Nifty is likely to take support, and we did, and we bounced off there. Do you think that there is a possibility we revisit those levels? That's 1,000 points away from current levels. And also, you briefly mentioned about the dollar index. Since you're also tracking technicals, what's the outlook out there? It's at around 112 today.
For the dollar index, certainly, we may see another test in terms of the highs on the dollar index. But as Mr. Yardini kind of pointed out, I'm of the belief as well that heading into next year, we'll probably see the Fed kind of pausing, because if you look at the inflation break-even rates for 2023. We're looking at a range of 2%. So if that's going to be correct, and if the bond market is correct, we should see the Fed kind of backing off, and we should see the dollar reverse. So, I think it's short-term pain, but we have to get through this period. And in terms of the sensex, we do see a lot of support at around the 21-day moving average. And that's only like a few percentage points away. 200-day moving average is 6% away, but I think there's going to be a lot of support around, let's say 59,400 at the 21-day moving average, or the 59,000 at around 50-day moving average.
Okay.
Ed, so broadly, I mean, is it going to be, the markets under pressure globally, Ed? What's your sense? And despite, what you're saying, and you're right, we hear so much from so many speakers, it's tough to make out who to listen to and not. Maybe they should just have lesser people speaking. But despite all of that, as you said, the chair is Mr. Powell, and he's very clear about what he wants to do here.
Yes. Well, I sometimes refer to the FOMC as the Federal Open Mouth Committee. There are many of them that are just too anxious to speak. And I guarantee you, we're going to have just one speaker after another in the next several days. And I suspect quite a few of them are going to be more dovish than Chairman Powell. Chairman Powell really just came out with the most hawkish position. I would call it Volcker 2.0, basically saying, we're just going to raise interest rates until we find the level that starts to convincingly bring inflation down. And that is Volcker 2.0. And I thought there was some indication that they were trying to kind of walk that back a little bit. Let's call it Volcker 1.5. But here he, once again, just pounded the table that by all means, they have to bring inflation down. And the only way they can do that is by pushing up interest rates. And if they push them up too high, they can always push them back down to revive the economy. But look, I'm concerned that they made a big mistake by not moving fast enough to get catch up with the inflation curve. And now they may be overreacting to that mistake and creating another problem. It could be a financial crisis, which is what the yield curve is telling us. Inverted yield curves are pretty good at predicting that if monetary policy continues to tighten, something's going to break. I don't know that it's going to break in the U.S. because the U.S. credit markets, capital markets, banks are actually in pretty good shape ever since the 2008 calamity. But clearly there are weak spots in Europe. I think China's got its issues. And of course, emerging markets get under a tremendous amount of stress when the dollar gets to be too strong.
Okay, well, we were just talking about how the word pivot has been overused, right? But guess what? Since 2020 is when pivot was the word of the year, as per the dictionary. So, I mean, it's been going on for, 2 years now. Thankfully, we don't have to use it anymore, at least for the time being. But Ed, just one final word from your end, right? What do you see as the way forward for the Indian market? Would you put fresh money to work now? Would you be cautious? What's the approach? And for emerging markets as a whole?
Are you asking me or,
yes,
or my co-panelists?
No, that question is for you.
Yeah, I think India definitely stands out as performing remarkably well in this kind of environment, which really tells you that the underlying fundamentals are giving global investors quite a bit of confidence that as they're looking for safe havens in this very crazy world that we live in, can't think of a better adjective than that right now. China's not a good place to invest in right now. And it seems that India is more immune to the pressures that occur when the dollar is strong. So I think global investors have been looking for safe havens, and among emerging markets, it's India, and among developed countries, it's the United States. And they've been putting their money in the bond market in the U.S.
Okay, all right. Thanks so much, Yardney, as well as Dean, for stopping by and giving us your quick comments. Let's see how this goes, but it appears we're in for a bit of a rough ride, at least in our equity markets today. Well, for the time being, let's slip into a short break. You come back, we'll have a lot of stocks that have lined up for you in our top 10.
Well, the SGX Nifty is indicating that the start will be well in the red. There's no reason to pause on rate hikes. That's the word coming in from the Fed, and that has spooked most global markets. But we have plenty of stocks to talk about, and our research team is here in full strength to help you with that list. So without wasting any time, let me start with you, Nigel. What are you looking at? Dalmia Bharat?
Well, that's right, Sonia. I'm looking at Dalmia Bharat, and it could be a relative outperformer. I don't know whether it'll open in the green because the markets are likely to see a sharp downtick, but the numbers look pretty good. It's pretty much in line with what our poll threw up, and that's actually good news because a lot of their peers, well, they missed the EBITDA estimates by big time, particularly ACC and Ambuja Cements. So when they deliver inline set of numbers, my guess is the street will like it. And keep in mind, second half of this year should be much better. Volumes are higher. We have heard about various price hikes as well. And also input costs will cool off. The capacity for Dalmia Bharat should move to close to around 49 million tons in the next 2 years. That's from around 35 million tons at the end of last year. So that's good news as well. And valuation-wise, there is comfort out there. It's always traded at a bit of a discount. It trades around 8.5 to around 9 times odd. But for a 50 million ton unit, trading at around 8.5 to 9 times, where it has some valuation comfort as well. So going with green on this one. But Abhishek, what about you? You're tracking Mahindra & Mahindra Financial. They came out with their numbers and operational update as well.
Well, Nigel, to begin with the operational update, it looked a bit weak, when compared to asset quality and collection efficiency. However, the monthly disbursals in October is at 13-month high of about 5,250 crores, which is up nearly 29% on a month-on-month basis. The gross NPA ratio for October is at 7% when compared to 6.7% as of Q2 FY23. The collection efficiency for the month of October was at 91%. This compares to 98% monthly collection efficiency for September. Coming on to Q2 FY23 results, the quarterly disbursements are at 16-quarter high, coming in at 11,824 crore, which is up 82.5% YOY and about 24.8% on a sequential basis. The loan growth pretty strong over there. The on-balance sheet loan growth is at 21.6% YOY, perhaps a 14-quarter high, and the AUM growth, which takes into account the securitized portfolio as well, is at 13.8% YOY, which is a 9-quarter high. However, PNL is not, balancing the growth that you are seeing in the business momentum. The net interest margin has declined quarter on quarter. The operating profits have declined massively by 15% YOY and about 8.7% sequentially. So in terms of our poll, the NII is a miss, and there is one exceptional item of about 54.5 crore, which has led to PAT missing our poll. Back to you.
All right, thanks a lot for that. So that's an M&M Finance, but let's find out how Relaxo Footwear and Gati did this quarter around. Mangalam, over to you.
Well, as far as Relaxo Footwear is concerned, it's a howler of a result, because the revenues, while they declined about 6%, the EBITDA actually halved from, 117 odd crores to just around 60 odd crores. And as a result of which, the net profit has fallen to 67%. The margins have fallen into single digits, 8.9%. And that's perhaps the lowest that we've seen in the last many quarters, if not the history of the company. The company says that the decline is primarily on account of, volumes of categories serving in the masses. And that affordability has hurt their demand, and at the same time they've cut their prices also as raw material prices cooled off, but they were still sitting on high cost inventory. Expect that stock to be deep in the red in today's trading session. But apart from that, Gati, well, the numbers were not bad. You got a 9% revenue growth, but importantly, their EBITDA margins expanded by 60 basis points. They were the lowest in the industry, and they've been guiding for EBITDA margins to improve. So it's good to see that that is on track. For the first half, their volumes have grown by about 28%.
Right, Mangalam, thank you very much for that. Keep an eye out on those names. Class A truck orders out of the US, Sonia, how are they looking?
They're looking good. And, this is the second month running that the Class A truck orders are above 40,000. So clearly, the trend has improved in the US in terms of, the heavy commercial vehicles. This time, North American Class A truck orders came in at 42,500 units, which is a 75% growth on a year-on-year basis, and it's above 40,000 for the second straight month. Now, ACT Research, which is the research firm that puts out this data, said that OEMs have now opened their order boards for 2023. The reasons for the strong Class A truck orders is the ongoing pent-up demand. There are tailwinds from strong carrier profitability and elevated fleet age, which is proving resilience. Now, they're also saying that there is a very clear visibility from OEMs for a strong first half of 2023, and hence the orders are flowing in thick and fast. In fact, if you look at the monthly trend, the data is looking good. I mean, compared to an average of 15 to 20,000 between June and August, it's gone all the way to 40,000 plus in the last 2 months. Positive for Bharat Forge, Ramkrishna Forgings and GNA Axles.
Okay, all right, Sonia. Thanks for that. Well, let's hop across to Surbhi. She's here to tell us about a couple of other numbers, Jindal Stainless and JK Paper. Surbhi?
For Jindal Stainless, the earnings are marginally better than what the analyst has estimated, but overall a weak set of numbers. The revenue is up 13% on a year-on-year basis. EBITDA came in at 411 crores, down 42% on a year-on-year basis, but better than some analyst estimates of 392 crores. Margins came in at 7.5% versus 15% same time last year, and this is due to higher other expenses and power and fuel costs, which were both up approximately 40% on a year-on-year basis. Net profit is down 48% at 189 crores. Next is JK Paper. They have reported a beat on all fronts. Their revenue is up 74% at 1,644 crores, which is the highest ever quarterly revenue that they have reported. And this is largely led by the volume growth, which was driven by the capacity expansion in their packaging board facility. Their realizations were also up despite high input costs. The EBITDA is up nearly 2.5 times on a year-on-year basis, and the margins are up 1,000 basis points at 33%.
All right, thanks very much for that. MTAR Tech and Triveni Turbine also reported earnings. Vahishta is here with details. Vahishta, hi.
Hi, Prashant. Good morning. Well, MTAR Tech has reported a good set of numbers for this aerospace and defense manufacturer. The revenues were up 38% to 126 crores. The margins, though, were impacted by some extent due to the high cost of raw materials, high employee and other expenses in this quarter. The order book is strong at 1,289 crores. And all in all, the company has reported good set of numbers in the first half of the ongoing financial year. But the company says that the second half is going to be even better on a sequential basis. The company is confident to achieve its FY23 revenue guidance of 55 to 60% on a year-on-year basis, and EBITDA margins could be at about 30%. For Triveni Turbines, well, also has had a healthy quarterly performance. The revenues have jumped 42% in the past quarter, which is owing to a strong growth in both exports as well as the domestic markets. The exports reported a strong growth of 93% on a year-on-year basis, while domestic market was up 18%. The total order inflows were also up 18% on year-on-year basis. Order book is strong at 1,100 crores. Also, the company has announced a buyback at 350 rupees per share, which is a premium of 24% from the current market price. And the buyback offer size represents 23% of the company's fully paid equity capital and free reserves on the consolidated levels as on FY22. So expect the stock to be in green today.
All right, thanks a lot for that. So here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow. There's Dalmia Bharat, Bharat Forge, Ramkrishna Forgings, JK Paper, Gati, MTAR Tech and Triveni Turbine. While the stocks with negative news flow, there's M&M Financial, Jindal Stainless and Relaxo Footwear. But a lot has happened overnight with the Fed going at it with a 75 basis points rate hike and hawkish commentary. Not much happened in the world of crude. Brent is still around the $96 a barrel mark. But Manisha Gupta is here to give us a roundup of all the action from the commodity market. Manisha, morning.
Morning, Sonia. Thank you for that. Well, yes, the prospects of higher rates going forward as well is something that did give us a knee-jerk reaction in the commodities as a sector. But then it is about the individual fundamentals as well, which really seem to be working. The markets do believe that barring next couple of quarters, you could be looking at demand coming back. That's exactly what the crude prices are looking at. The reason we are still holding around 90 for U.S. crude and near 95, 96 for the Brent is, and this is at 3-week highs, by the way, that you have seen a constant decline in the U.S. crude inventories yet again in this week also. The OPEC and allies output cut have continued to decline. The latest data for the month of October shows that they are off mark and way off mark from their agreed quota. And then the European Union embargo that hits Russian oil imports on 5th of December is yet another thing that the markets are taking a cue of. And then there is a winter demand to look at as well. So you wouldn't really see a sell-off coming in case of crude oil prices until we continue to see these supply concerns. But that's about crude. That's the same thing that you are seeing in metals as well. After that initial sell-off, there is buying that has come back in copper, nickel. Gold and silver also trading in the positive in the Asian markets right now. So there is those shorts that seem to be getting covered at this point in time.
All right, Manisha, thanks very much for that. So that's commodities. We'll take a very quick break here. Up next, Nishal Maheshwari joins in, sent from broking for some fundamentals stock talk. What does the market do here? I mean, that's the big question, isn't it? And what should you be doing stock-wise? So that conversation follows in just a bit.
Welcome back. Well, the SGX Nifty is suggesting a down day. 160-point downtick is what we'll be bracing for. So in Nifty terms, we'll be starting, if we get a 160-point downtick, it'll be at around 17,920 odd. 17,900, my guess is that should be a crucial level that the bulls will be tracking. Today's expiry as well. So things will get a little bit volatile in the second half of trade. Well, Nishal Maheshwari, CEO, Institutional Equities and Advisory at Centrum Broking, joins in. Hi, Nishal. Morning. Well, before we get to discussing about some results, I want to ask you about the biggest loser yesterday, Bharti Airtel. It was down close to 3%. 12 months or so ago, there was a consensus buy on the stock. now suddenly a couple of brokerages sounding a little bit cautious. I think there's a Deutsche Bank report that came out yesterday. There's a Jefferies note as well that sounded a little bit cautious. Your view on it?
Morning, Nigel. I think more to do with profit taking. I don't see that there is any reason for being cautious at this point of time, even though we do not cover it at the moment. But I continue to believe basically that there is a likely tariff increase which is going to happen anywhere in December or January. And maybe some amount of profit taking, given that we have now got some aggressive valuations. That's the only reason I see for taking away some profits. But otherwise, I would be a buyer on the stock.
Profit taking in Bharti Airtel. I would continue to be a buyer in the stock. Nishal, good morning. This morning, Motilal Oswal put out a very interesting note where they've raised the EPS targets for the Nifty for the full year. And they talk about how 4 stocks, Axis Bank, Sun Pharma, HCL Tech and ICICI Bank, strong results over there, the reasons for the upgrade. Among these 4 names, do you like any where one can put some fresh money to work?
Morning, Sonia. I think out of the 4, definitely I would put some money on Sun Pharma and HCL Tech. Sun Pharma, obviously, the results were outstanding in HCL Tech because of valuation. Maybe something on ICICI also. So these, I think, but I would prefer the first 2 actually, Sun Pharma and HCL Tech. And I would wait for some correction in the banking sector and then maybe go again investing into the bank.
Right. You know, one of the other things which has happened, I think, yesterday evening was that this entire China reopening thing, I mean, that has been completely quelled. So we heard from an official spokesperson that there is no change being planned in the COVID management strategy. It may happen, but it's not happening right now. That's the point. Metals essentially have been doing very well last 2 days. Day before yesterday was a pretty large day for the metal index. Yesterday also, they did well. Any thoughts, Nishal, on that space on the back of what we've heard?
So morning, Prashant. I think metals is past its peak, basically. That is very, very clear. And given that we are, after this 75 basis point hike again yesterday, there is a very clear chance of a recession in the US of maybe a couple of quarters. And definitely if a recession happens in the US and other developed market, exports from the emerging markets are going to get hit. So my view remains to be basically if there is slowing down of economies across the world, I don't see any chance of metals doing well. So I think as a sector, I think if one has exposure, they should be cutting it basically. And it's best avoided at this moment.
All right, Nishal, what about ITC? Beautiful set of numbers, from extremely attractive valuations. Now it's trading pretty much par for the course. At around 355, everyone's waiting for the Nifty to go to a fresh high. ITC, well, it's already at a fresh 52-week high and up more than 60% in this year. What do you do with the stock?
So we continue to remain a buyer, Nigel, there. Basically, we have been a buyer from around 160, 170. And we continue to believe basically that the discount was unwarranted for ITC. So people are talking about ESG and they had come out with a score basically saying that they are one of the best companies as far as ESG is concerned. And thereafter, basically, we look at it on cash flows. I think a lot of that is floated around basically that cumulative cash flows for the next 3 large FMCG companies. ITC had a better cash flows than the cumulatively for the next 3 companies. So I think those were the points which we had when we had put out a very strong buy on ITC. We continue to believe basically that the discount at this point also is unwarranted. And if they are able to do some maybe a hotel sell-off or maybe separating and getting it listed, I think that's another trigger. So if one is holding ITC, should be holding in and maybe keep on looking for fresh buying opportunities.
Okay. ITC, right? It was a huge meme fest after which ITC decided to prove everyone wrong. Got that. Okay, from the auto sales trends that we got yesterday, at least for the month of October, there were some standout performers, Nishal. There was M&M that hit record sales in tractors. There was spectacular sales from iQube for TVS Motor. Tata Motors continues to do well in electric vehicles. What's your pick of the pack now?
So I think CVs continue to be the one basically which we are preferring. We had like two-wheelers earlier basically that didn't turn out as well as we had expected. But CV definitely on the back of strong economic performance, basically I think that's a sector basically we are betting upon. Obviously the pent-up demand on the four-wheeler side is seeing up, and we've seen our Maruti doing pretty well. So our pecking order is CVs, cars, and then two-wheelers.
Okay, all right. CVs, cars, and then two-wheelers. Got that. Well, it's been very strong even for the commercial vehicle space, specifically for names like Ashok Leyland and Tata Motors. We'll come back and track some more stocks. We have a new IPO as well today. So more on that in a bit. But before we do that, let's listen in to what the former RBI Governor Raghuram Rajan had to say on that 75 basis points Fed rate hike, the cautious commentary from the Fed, and the way forward for the economy. Listen in. Welcome back. We have about 10 minutes to go before the pre-opening rates kick in, and it's not going to be a good start to trade. That's because of the global cues. But let's find out how to approach our own markets. Mitesh Thakkar of earningwaves.com and Sudarshan Sukhani is with us. Gentlemen, morning to both of you. Sudarshan, let me start with you. You know, this market has been so resilient. So do you reckon at some point after the gap down opening, there could be a buy on dip? Today, tomorrow? And if yes, how does one approach it? I mean, do you look for that opportunity or do you stay cautious?
Yeah, good morning, Sonia. Well, yesterday the idea was to step away because there was big news event. And I think this consistent approach of staying away on news events has been paying off. Now, we are going to see a gap down. I'm not so worried about that. You know, when a market goes up, some correction is inevitable. Now that correction can come in the form of a news event as we are seeing today, or a slight slow drift downwards. It doesn't matter. We can't order it or pre-order it. It's only a correction. So a buying opportunity is going to come in. Now I don't know whether it comes in today or tomorrow or even Monday, but in the 3 trading days starting from today, whenever the markets find support, again a level is not clear, but wherever they stop falling, they start consolidating sideways. That would be a buying opportunity. I think it should happen somewhere either around 18,000, which is where we will open approximately, or somewhere around 17,800. I can't say where, but the trade is to be a buyer once the market decides to consolidate.
Okay, Mitesh Thakkar is also with us. Mitesh, good morning. So do you reckon that there could be a phase of consolidation before the market takes the next leg up? And if yes, what would the approach be today post the gap down opening?
Yeah. Good morning. So my belief is that, yes, I think, yesterday towards the end, we saw the Bank Nifty and the Nifty hourly charts kind of get into corrective mode. And my sense is that I think, with this happening, the markets will, at least for the time being, stop making newer highs and possibly go into some kind of a pullback, profit booking, come consolidation mode. Having identified this, I think the next job is to figure out which levels could possibly come into play on the downside and which could be a good buying area. So my sense is that today, I think we'll open below 18,000 levels. The bigger support, which was the gap which was created on Monday, I think should come into play very soon. That level is closer to about 17,850, 870 zones. And I think around that level, or even just below 17,900, I think if we get a chance, I would want to take a long position with a stop below 17,800.
Okay, all right. Buy the dip seems to be, the play, the trade today. Let's see whether or not that works out. But Mitesh, you go first with regard to your stock calls for the day.
Yeah. Morning, Nigel. I have a mix of buys and sell calls, 2 buys and 2 sells. On the buying side is Sun TV with a stop at 532.5 for targets of 570. And Oracle Finance is a buy with a stop below 29.50 for targets of 30.30. And Bharti, I think, came into some kind of a corrective decline yesterday. I think that could see test levels of around 790. So sell with a stop at 819 here. And Canfin Home was a sell call yesterday as well. I think it could possibly go down to about 490 odd levels. So that's a sell with a stop at 516.
Sudarshan, what about you? What are your trades?
Well, they're mostly intraday shorts because we have to understand when the market stop falling and start consolidating, and we cannot time that. So Biocon, we usually look at weak stocks to go intraday short. Biocon is one of them. Consider selling it with a stop above 273. M&M Finance is another intraday short. Again, a weak stock, in relative underperformer. Stop above 199. PNB has been a disappointment. 2 days ago, it had a very big down day. That's an intraday short with a stop above 40. Just to wind it up and keep some cheer. Ultratech Cement, and that's just not just Ultratech, it's almost all the good cement companies. Ultratech is a buy with a stop under 6,700. You could really look at any other cement company also for buying.
Okay, thanks a lot for that. Well, many more stock ideas are coming up in just a bit, but we need to take a short commercial break, so don't go anywhere. When we come back, we'll have the pre-opening rates. A gap down opening is coming up, but we'll also have with us our first guest on the show, Pirojsha Sarkari of Gati, to talk about their Q2 earnings and the way forward for the company. Stay tuned for that.